Friday's sell-off on the Chinese reciprocal tariff news certainly started to feel like a capitulation gap down, but there's nothing yet on the intraday that's even close to helping call a strong market bottom. For me to feel comfortable making the call, I would want to see at least one of two potential outcomes that we'll cover in today's episode of the Trade Brigade Weekend Show. So welcome back, let's take a look through all of the data points, including new downside levels, and let's build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got two additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY monthly time frame chart, and admittedly, the April bars are brand new. They're not even close to closing yet. However, the range is clearly substantial. So the question we have to ask and answer is, has the monthly trend broken here? Are we in a monthly downtrend all of a sudden? And to me, the answer is no. Now, admittedly, in last Saturday's update video, I sort of built the case for being very interested in the retest of this previous breakout level, which is also confluence with the monthly 20 SMA, which we've just added in orange. And in full transparency, I did add some long-term capital to the accounts at that level. About 10% of available cash got deployed on Friday morning, but you can clearly see that we've closed underneath. So back to the main question, is the monthly trend destroyed here? Was that a bad idea? To me, the answer is no. The monthly trend is not destroyed, and there's still an opportunity for one particular level to offer a clean higher low. If we're thinking about the trend count, we still have lows, we have soft higher lows. This is a firm higher low because we've actually flipped into a weekly downtrend in that time frame. This is a soft higher low here, and you can still see that the market has not even produced an equal low to the previous soft higher low. However, the level of interest to me is the previous all-time high after the sickness rally prior to the 2022 bear market. And this level comes in at 480. And the 480 level is sort of interesting to me because it also has confluence with the monthly trend line off of the sickness low. If I do something that looks like this, you can start to see that you get confluence right around this zone. And it's very possible that the monthly 50 SMA in blue could catch up to offer additional confluence in that area. Now, how am I going to play this from a higher time frame perspective? I'll probably look to add another 10% of available cash if the market extends losses and reaches this level first before producing some sort of reversal pattern in the upward direction. So my point is, on the higher time frame charts, the trend has not changed here, but now we've gone into deployment number one in terms of capital. Deployment number two means waiting patiently for the next confluence area of support, and if we support off of that level, now we have a reference point to manage risk against. So that's the next level I'll use on the higher time frames. Let's drop it down to the weekly time frame chart. We don't need the 20 SMA anymore. We'll get rid of that. And of course, candle structure, location, all the usual stuff we dive into. Let's take a look. We of course have a solid red-bodied bar with a substantial upper wick, very weak close, dead on the lows of the move. The range is really large relative to everything that we've seen recently. Undoubtedly, bears are in control when it comes to structure. They're also in control, clearly, when it comes to location via a clear bar-to-bar lower high as well as a lower low, and once again a close smack on the bottom of the weekly range here. I would like to point out that, of course, Thursday and Friday are responsible for almost all of the downside candle body that we see on the weekly. Monday, Tuesday, Wednesday is actually not much more than just consolidation inside of this range. However, I still think it's worth talking about the upper wick of the weekly structure. Notice that the wick rejects the weekly 50 SMA, which is the bottom end of the do or die zone, which, as we know, is confluence with this previous weekly structure from back over here. Previous resistance acted as support, acting as resistance again. It was bearish even Monday, Tuesday, Wednesday, right? So outside of the tariff move to the downside, the bears were still in control from the weekly perspective. There was nothing that was overly changing to the bull side on the weeklies. If we come in with the Fibonacci's, of course, undoubtedly, if we do something that looks like this, we're underneath at this point the August 5th yen carry trade explosion low. So that fib is no longer really useful, but we can come in from the high and start measuring down towards the low. And what I find somewhat compelling about this now is even if the market were to retrace some of the big downside that we've seen recently, a 38.2 retracement keeps us underneath the bear flag lows of this pattern right here. So is there a clear path forward in terms of a weekly trend reversal here? The answer is no. And I know we didn't explicitly say it, but obviously the weekly trend is still down. Highs, lows, lower lows, big time lower lows. We can afford another lower high. And once again, anything that's underneath this 550 mark is really going to produce a lower high beneath a Fibonacci 38.2, which is inherently bearish as well. Let's come in here with the anchored VWAPs on the weekly. And we can see, this is not a shock to anybody, that the confluence of these is right around the upper wick of last week's bar. And so far, we've closed underneath everything that has been substantial in terms of anchored VWAPs. There's nothing here that's saying, hey, we have one last-ditch effort of support. We're underneath it all relative to the last major monthly higher low. Remember, this is the weekly downtrend we were talking about. This is not really a weekly downtrend over here because of the way it wasn't even close to retesting this, right? You have lows higher lows on the weekly time frame chart. No lower high in here whatsoever. So in the perspective of the higher time frames, the monthly still interesting for that 480 mark, which is just kind of a hop, skip, and a jump away at this point. But the weekly, man, it does not look good at all in terms of spotting a bottom off of this nasty move that we've seen in the very weak close from Friday. Let's quickly check in on the volume profile. Here we go. It's like trying to read the studies in real time there. What do we have in terms of the high volume node underneath us? We did close underneath this, right? So once again, another bearish takeaway happening here. Even as we were getting the consolidation Monday, Tuesday, Wednesday, look at this high volume node, or just the bottom end if you wanted to cluster all of these points as a major zone. If you did something that looks like this, clearly we're underneath that. And once again, any rally retest rejections just offer a weekly lower high, which is going to sustain a little bit more of that bearish pressure across the broad market. Let's take a look at the daily time frame chart, because if there is going to be a capitulation style V-shaped recovery, very similar to what we had over here, this is the yen carry trade explosion V-shaped recovery. It was a lockout rally straight back to the upside. And there's a couple of things that we need to look out for, and I primarily mentioned them in the intro. There's two situations where I'd be inherently interested in the lockout rally higher. The first one would be that on a gap down, the market actually rallies to close the gap overhead. Notice that on the yen carry trade explosion, and I know we're zoomed out here so we can see both at the same time, but let's just look at August 5th in particular. On the gap down, there was very little further downside, and the market actually rallied and closed higher. That, of course, did not take place on the Friday session. You can see we opened on the gap down. There's a small attempt to rally higher, and then where do we close? Smack on the lows of the move. So the first thing you would want to see is a failure pattern, right? That's what we're getting at here. A failure pattern is required if we're going to produce a capitulation low. So what might that look like going forward? Well, we could either gap down again on Monday, which honestly doesn't seem that crazy. If you think about the retail cycle here of what's potentially happening over the weekend. Your mom and pops are going to call brokers over the weekend, or they're going to send furious emails as they start to check in on 401ks. I think you're going to see some lagged selling, honestly, early on into the upcoming week as people are just continuing the panic here over the weekend. Now, it's not to say that markets, this is the saying that you see all the time online, markets don't bottom on Fridays, right? If you actually look back, the October 2023, was it? October 2023, the low was on a Friday. Anyhow, we're not going to go back. You can go back and find it on your own. But regardless, at this point, if we get another gap down on Monday, and yet the market rallies in the upward direction after the gap down open, that would start to have me more interested in a potential capitulation low being formed. I would start thinking about that as a potential long opportunity. The other thing that could happen is that we open inside of Friday's range, so there is no gap down. We get a push underneath Friday's low that then rallies to accept back inside of Friday's range with a higher low intraday, in which case we'll look for the rally back up to start closing some of these gaps overhead, and that potentially could start to signal the bottom of the move here. Now, I know we've just jumped right into the failure patterns, and there's one more thing that we can watch out for, which is divergence. We'll talk about that when we get to the market internals. But for now, let's get back to basics and evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is at 538.22, implying a big time lower high on the daily time frame chart, and it's also underneath the bottom end of the weekly consolidation that we were just talking about, which would classify as a weekly lower high, as well as bear flag consolidation underneath the fib 38.2. So that's noteworthy here. Remember that that level is 550 up here. The expected move high is well below that. Once again, 538.22, that's bearish. Obviously, the lower bound is much lower. It speaks for itself. It's a clear lower low in the trend count, and we're looking at 472.28. Now, what you might notice about that is it's right, almost not quite on par, but it's very close to the 480 monthly level that we were just referencing. So if the market is going to sort of test this lower level this week, it wouldn't strike me as being unreasonable, right? It's well within striking distance of the market. Now, what I do want to at least acknowledge here before we move into the levels a little bit deeper is just that last week, we've seen about a 3 sigma move close outside of the expected move. So are we getting close to putting volatility in the rearview mirror? Are we getting close to, I think it's worth just drawing the diagram here, so let's just do it quickly. We talk about this spectrum, right? We've recently been joking around a little bit, calling it the FU spectrum, where we have fear on one side, and not literally FU, but then we have euphoria, little e, big U. That's how you get your FU, right? So you have fear and euphoria in the market, and in the middle, you have something like complacency, right? The tariff announcements that we got on Wednesday evening sort of put us much closer to the fear side of this equation. And it's my belief, and you can argue with me in the comments, that's fine. It's my belief that walking forward, someone is going to bend the knee. It's either going to be the president and say tariffs were a strategy to get to the negotiation table and let's try to get to free trade and everybody should go to zero and that's the goal, or Jerome Powell bends the knee and Jerome Powell starts lowering rates more aggressively. Of course, Trump wanted him to do that on Friday during the editing conference or whatever it was, which was a total joke of a conference, but it didn't happen, right? Powell seems to be pretty firm in his ways. He's saying, nope, we're not going to cut rates. There's no reason to do so. The labor market's fine right now. I want to make sure inflation comes down. But then Donald is also saying these tariffs aren't going anywhere. Like, welcome to a new regime. So I think that the max fear is mostly behind us at this point in terms of new information that the market's trying to digest. And if someone bends the knee, it gets us closer to the midpoint here, which could be complacency. I'm not calling for outright euphoria, oh my goodness, new all-time highs. But if we're looking for a bottom, if we're trying to gauge where we are on this spectrum of the maximum volatility roadmap, I would say that this is starting to get closer to the end of maximum volatility as compared to just the very beginning stages, right? So that conversation is useful because we can see the explosion of the lower edge of the weekly expected move last week. If we're contained within the expected move this week, I would carry that forward as a sign that, once again, we're moving closer to the complacency bit, which is then where the market bottom starts to form, right? So that, to me, is a worthwhile conversation. In terms of the levels in what we're thinking about here, the fact that the market closed smack on the lows of the Friday session, once again to me, would indicate that it doesn't seem as though the selling's done. It seems as though there's likely more that's going to come for sale early in the Monday session as people sort of grasp with this over the weekend. You're going to get a number of, just retail, but then also new economic models plugging in all these reciprocal tariffs, running models, doing this, doing that, making different forecasts. I'm not saying like we're out of the woods here. Like, it seems like there could be some further sell side. Now, obviously, there's not even a conversation to have about either respect or lack of respect for previous levels. There's no stopping the market here. There's no stopping the market here. Here, the August 5th low. We've done some labeling so you can try to get a grasp, use some reference points as to where we're at. Just nothing, right? Nothing is stopping the market on this foray, if you will, in the downward direction. So if we start to see continued sell side, the next few levels that I would reference, 495 is the major one. There's a little bit of a buffer on either side. You have 499.75, 491, and then you have that 480 level. It's really 479.25 if you want to be precise, that I would use as the major monthly high or low. I do want to zoom out on the daily time frame chart so you can just get a sense for where these reference points are coming from, and you're not just like adding levels to the chart blindly here. If we're looking at 495, it's this major pullback low before the extension of the rally here. You can see a previous high, and let me zoom in on this so we can really see why we have a buffer on either side, right? Previous resistance acted as support on the inside bar candles, lower wick happening in here. That's 491. And then over here on the attempted breakdown that formed the low, the exact low is the 495. But if you look here, previous two equal lows then acted as support. It was almost as though you had a look below and fail, right? This is your higher low here, and that's where the market sort of launched from, right? So that's where those reference points are coming from. And we all saw on the monthly where 479.25 is coming from. If you really want to have some dire straits levels out there on your charts, we have this 467, bottom end of this consolidation. Thin structure retracement brings us back down to the breakout point, 459, to give you some deeper levels to the downside. So that's what we're dealing with on the downside there. If we were going to see a instant, maybe I shouldn't say instant, but rather a stronger move out of the gates, I think what would need to happen is some sort of gap down that accepts not only inside of Friday's range, but something that's over the August 5th yen carry trade panic low that's at 511.50. That would start to become a pretty solid indication to me that we can manage risk against this set of local lows, looking for moves to potentially close the gap. If you're thinking from a risk reward perspective, your higher low, once you're over the August 5th low, starts to set up ideas that look like this, right? Risk and reward to potentially come in and close that gap overhead. Now, let's not lose sight of the fact that the daily trend is still down, the weekly trend is still down, and we have this very clear rejection point where the market can easily produce any lower highs underneath this level up here. Generally 550, 548 would be top of mind. Now, you could also build the argument very easily, and I hope what you're seeing here and noticing as I'm going through the live analysis is just that, like, this is such a disruptive move to the market. You really, really need to have an open mind as to what can unfold here. There's a lot of money to be made in volatility, but there's easily lots of money to be lost as well. One of the bearish indications that would be like, we're not even going to test 550, would be the market looks into the gap over Friday's high, fails underneath, lower highs underneath Friday's high, or the opening print even at 523.75, I would start looking for shorts back down towards Friday's low as a potential target, in which case we're trading shorts, right? Risk, reward here, and ballooning runners into Friday's low, monitoring for continuation beyond that. So a lot of levels, a lot of new levels to digest, a lot of seeing and gauging how the market responds to these potential tests. I mean, these are historic levels. We've not traded these areas in a very long time, so testing and probing them should give us some insights as to the market's reaction when we approach them. Let's take a look at let's go on down to the hourly chart here. Let's take a look intraday and even throw on let's go on, where am I going here? I want to see the intraday anchored VWAPs just from all the nonsense that's sort of been going on all underneath everything, which is like not a shock, of course, but I just wanted to see if there are any reference points that are like beautiful tie-ins. This is not bad. This is not bad. So the equal low back here is actually confluence with the gap close. And I do want to attach this now to the high of day from what would have been Wednesday. So it's 12:30 on Wednesday, which was what? That was 4.2. Let's do this in real time here. Let's bring this out to 4.2. Let's click in there. Let's go 0402, and then let's go 12:30 for anybody who's maybe curious about anchored VWAPs on Thinkorswim. This study is available over on our website, tradebrigade.co/trading-scripts. If we attach an anchored VWAP to the high of that Wednesday session and take a look, it's actually going to signal a perfect confluence there with the high of Friday's session. So that is interesting, and I would actually aim to, let's do this. Let me reset this a bit, and just so we can do the same thing over on the QQQ, I'm going to bring this one over to 4.2. So thanks for bearing with me. I know it's not always what you want to see, but this is once again how you do it. You can change your time frame over here, boom, and then we will save this as a study set. There we have it. Let's replace. Perfect. All right. So long as we're underneath the cascading anchored VWAPs, obviously the hourly trend is not going to change either. The failure pattern off of the lows, I think, really speaks for itself. You open in range, you move underneath Friday's low, catch support, maybe let's just call it 499.75 back in Friday's range. I think this starts to look more like a counter trend move is available for a rally in the upward direction, which we could try to exploit on the long side, right? As long as you're someone who can stick to your stop loss here, it's a trade I would certainly entertain, especially in the throes of volatility here. If we're just consolidating underneath the August 5th low at 511.50, I would want to see, so it depends, right? If it's just a quick opening drive to the downside that tests and comes back in, I'm more interested in this. If we get more so consolidation that continues to reject, or even like a look above and fail on 511.50, I would want to see equal low breakdown. Count me in, coach. We'll look for shorts to continue the losses, something that looks like this. And this perhaps aligns a little bit more so with just the idea that it seems like there's probably more stock that's going to come for sale with the week close on the Friday session here. We don't oftentimes talk about volume, but market on close orders, I think it was leaning like 5 billion to the sell side. So just as an FYI, that's pretty extreme, right? So those are the hourly comments and thoughts. I would say we know where we're long, we know where we're short. This, of course, if we're inside the gap overhead, we of course could look for risk reward along these lines, but once again, reevaluating for a potential lower high up against the upper edge of the weekly expected move, gap fill reversal, anchored VWAP confluence from back over here Monday of last week. All of these things are sort of top of mind. And once again, I hope what you're seeing here and acknowledging is that in the throes of volatility, almost anything goes, where, the failure is what's required if we are going to put in a capitulation style low. If the market's going to extend the losses to the downside, bear flags, sure, they play. When we get here, set up a counter trend, show me a lower high underneath the 511.50 equal low breakdown. Great. We know what we're aiming for. It's 479.25, which of course is the monthly level that we were just talking about. I want to go back to the daily chart one more time just because I want to ensure that everyone leaves this S&P analysis feeling good before we move into the market internals, which, again, don't get me wrong, there's a lot of analysis still coming up. But if you're someone who's like, higher time frame, I just want to find a higher low, I want to get involved on the monthly, I want this chart to turn around, this is not, like, catching the falling knife in these circumstances is not really the way to go about finding the bottom. You need that divergence or the failure pattern if there's going to be a lockout rally. And then once a lockout rally were to take place, you would basically want to set some sort of daily high or low if we were to do something that looks like this. And I'm just drawing hypotheticals now. And then if you were to take out the higher high, that's where you can say, great, we have a higher low double bottom. We're over the neckline. Now a more structural low can be put in place. We were very close to a situation like this way back over here, right? If we had taken back out these highs, then we would have said, great, we will look for these outcomes in the upward direction. But as of right now, you're still at this phase, right? You're still on the left side of the pattern, and there's no sign of confidence in terms of the bottom being put in place. A structural low, if it's going to happen, is going to require a little bit of time. So that's my spiel about the S&P daily. Let's go on over to the market internals here. And I think that this screen should really speak for itself. If you're not familiar and you don't know what these are, check out the video tutorial in the top right-hand corner. But for people who do know the market internals, this is one of the worst breath readings I've seen in almost probably since actually just the sickness low. And when the market was exploding with limit downs back then. This is more than twice, more than 3 times the substantial read of volume flows on an individual day. So that is number one red flag to confirm the sell side activity that we've seen here. We also saw substantial volume outflows on Thursday. So yes, it's starting to look like capitulation as we move one screen to the right with our correlation. Very, very correlated. You can see that the advanced decline line is in trend lower zone on Thursday and under trend lower zone on Friday. If you take a look at, I believe it's in the market watch tab here. If we go from a heat map to maybe index watch, and let me just quickly throw in the good old S&P 100, the advanced decline line was 4 to 97. So you want to talk about correlation. This is correlation, and correlation starts to get you closer to capitulation, or at least the main event in terms of volatility being in the rearview mirror. So this is confirming that, yes, it's aggressive sell side, but it's probably the extreme, if you will, of sell side is likely either at its climax and about to subside, or it's going to continue for another day or two, or this is already it, and it's done, right? You can see out of the cumulative build, out of the tick down here, very strong read to the downside. Thursday, a strong and decent read to the downside as well. And the index score, weak on both closes, right? The index score is weak. This means that it closed underneath negative 20, right? Underneath negative 20, you will get the added label here where the index score is weak. This is not a market to try to go catching the falling knife in when the internals look like this. So when I was talking about the failure patterns just a moment to spot the V-shaped recovery style reversal, that's one way. The next way is divergence. And what I've done here is I've actually taken the August 5th example, just because it's the most recent one I can think of at least, where we had a real capitulation style low. Let's scroll back to August 5th and let's just take a look at what we were dealing with back then. And primarily what I want you to focus on is the index score that measures from the opening print, right? So on the Monday session, just to give you an idea, this is Monday, this is the August 5th gap down, this is Monday, this is the August 5th gap down. Volume flows were very substantial to the outside, like down, outflows, right? And that's not a shock because there was a gap down. Obviously, we were disjointed from the previous day's close, which is what this measures from. Same thing happening here. You're really correlated to the downside, which aligns with capitulation. But notice what your index score does. Your index score is actually divergent and it's green. If you compare that to what we had just a moment ago on Friday, we did not have green reads from the opening print. We also had on Monday here, not as bad of a cumulative build out of the tick. I mean, it was close to negative, what do we have here? Negative 8,000. This is actually a 5-minute chart, I'm realizing, so we have to bring this to a 15-minute, otherwise there's more math that's involved. That would skew the read. If we just zoom back in on, this is the Monday, August 5th session right here. The cumulative was only down around, air quotes, but only down around negative 2,700. Whereas present day, we were underneath negative 5,000, which is the substantial read mark. So intraday, when the August 5th capitulation gap down took place, there were some subtle signs of bullish divergence from the opening print, namely this and namely this. And now what you're looking to pile on the next day is a strong rebound in the upward direction here, 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 and you can see the tick as well. If we see follow through to the upside out of the market at the exchange level, that might help build the case for a stronger V-shaped recovery taking place. So bottom line is we did not see, or I do not believe that Friday yet has the divergence or the failure pattern enough to look like the bottom of the move. And as we walk forward, we need to see internals not just confirm upside, but sustain upside confirmation, right? And that is what we have out of this dashboard. So hopefully that's useful in terms of your analysis moving forward and watching on the intraday. Let's jump on over to the market profile. There's really not much nuance to glean from this whenever we're dealing with the throes of volatility. Obviously, value area substantial to the downside. One thing that you could take away perhaps is just that the point of control is slammed at the low of day there. The only takeaway might just be that if people are ditching and bailing at the very bottom of the move, and you could think of this as momentum sellers going out short over the weekend. If they're going to squeeze, it would just mean that that's probably easier to do sooner rather than later if we end up opening inside of Friday's range on Monday. That's yet to be seen, of course, but that is one takeaway here, just that the point of control is basically floored to the lows, not left above for a potential tag and then lower high, right? This is, okay, we open above, use it as support, and now you squeeze out momentum shorts who tried to hold short over the weekend, right? That's one takeaway. I would not hang my hat on that. That's like one tiny minuscule data point in the pool of data points that we've examined so far, which likely confirm, right? Everything we've seen so far confirms we're still in the throes of volatility. We're getting close to a capitulation low, it seems and feels like, but we're not all the way there yet, right? Let's go back on over the charts here. Let's reset this over to our good friend, the nasty NASDAQ. Let's jump on up to a monthly time frame chart, and let's take a look just at that confluence level, see what we have here. We're much closer out of the QQQ, and if we bring in a trend line, it's actually, we're going to need a little bit more time than 5 years. It's crazy to think that that sickness thing happened that long ago. It feels like just yesterday. Anyhow, this, you can see, is not nearly the same confluence, and the soft higher low zone that we wanted to see hold, basically, or the breakout level that we wanted to see hold has been violated as of Friday's close. Same thing on the NASDAQ as the S&P, basically. And in here, we would be looking at, the level is going to be 405 roughly. 405. Monthly 50 SMA is slightly underneath. And if we come in here with the 20 SMA, obviously we closed underneath on Friday as well. That was our tie-in here. A little bit higher up, closer to the 450 mark. Just no dice on the buyers stepping up. The headlines were no match, right? So let's bring it down to the weekly time frame chart. Let's continue along with the analysis here. And why is that not removed? Let's try that. There we go. What do we see? So candle structure location, very similar to what we had over in the S&P 500, where you have a solid red-bodied bar, upper wick, rejecting inside of the consolidation range here underneath the weekly 50 SMA. Clear break of the equal lows, big time lower low, lower high as well. Nothing bullish to lean up against. Or hang our hats on. We've got the August 5th low. We've got the equal low, basically. There's nowhere to hide. There's nowhere to hide in tech, and this, to me, starts to become a little bit more about the growth story, and we'll see this as well when we get to energy, oil, crude. The idea that growth is going to slow down, the idea that we're in store for a growth recession. I wouldn't even say at this point, with oil falling off of a cliff, it's less about a stagflation, persistently high inflation recession, and more about just a growth scare. And we'll see this as we continue through the analysis, even in the IWM as well. So weekly QQQ NASDAQ tech is basically suggesting that valuations were far too stretched. There is going to be no growth, and good luck catching returns, right? That's what the market's pricing in here, basically, as we build, as a trade war is emerging. Let's frame it that way, right? If we bring in these lows and break underneath them, we can see that there is a thin structure retracement through this segment of the chart, probably closer towards roughly, what do we have? Weekly 200 SMA and 390, which would be an overshoot of the monthly level that we just talked about. Let's go down to the daily chart. Let's get a little bit more nuanced in the analysis here for the NASDAQ. And see what's happening. Obviously, it's not even worth putting the Fibonacci on it. Obviously, we're underneath. Fib 38.2 is going to align somewhere in here. The anchored view apps on the Qs weekly going to be underneath all of them. There's nothing to really hang your hat on there, as we were saying. So let's get a little bit closer to the daily. Let's take a look at what's happening from this point of view. Let's dim this back and we'll jump into the analysis. Sorry that this was not done ahead of time. I find it to be a little distracting when it's still full force. There we go. So expected move this week out of the NASDAQ is going to be at 451.30 on the upside, offering a clean lower high underneath the weekly bottom end of the balance. That's bearish. The bottom end of the expected move at 390.397, clearly speaking for itself, a big time lower low. If we close the gap, its confluence with the upper edge of the weekly expected move, a great spot for a lower high on both the daily time frame chart as well as the weekly. If we're thinking about previous reference points, there you go. There's your close underneath the August 5th low. If we are going to move down into that monthly level that we were just examining, that is technically from 2021, not 2022. It's December. But 404.50 is the precise level if you want to use that reference point. Low edge of the weekly expected move does have confluence with a previous reference at 392.50, and all of the same comments we had on the S&P apply here. Just understand that these are historic levels. They have not been tested, obviously, in a very long time. We'll do our best to evaluate the reaction off of them, but I'm not going to second mortgage the house at any particular level down here, trying to make a big, bold claim that this is going to hold as the do or die support, right? So that is that. And I know, speaking of the do or die theme that we have around the channel and the zone that was up above, clearly we've extended the losses underneath the do or die zone. I thought that may have gone without saying, but the DOD reminded me of at least acknowledging that. You can see where they're coming from. There's an unfilled gap here out of the NASDAQ. That's way down below. That's at 382.60, closes down at 378.50. That would be an extension through the lower edge of the weekly expected move. As we said in the S&P 500, if you do start to notice that the NASDAQ is staying nice and contained inside the expected move, then guess what? Maybe the volatility storm has come to pass and we're in the clear. One of the things that I'm remembering now as we're talking through all of this stuff as well is that earnings season is going to get kicked right back off on Friday with financials really kicking it off. It's the big banks, JP Morgan, Goldman Sachs. We'll take a look at the earnings calendar in a moment. So is it fair to say that volatility is maybe behind us? With earnings season coming up, it really complicates the issue here. So we're absolutely dealing with a market where I think if you're overwhelmed by it, just remember the market's not going anywhere. You can wait for conditions to settle down. You can wait for better trade opportunities to present themselves. You can wait for things to just calm down. Let's get back to a normal environment. And then let's just rinse and repeat the bread and butter setups, right? So with that in mind, risk management is paramount in these conditions. As I've been saying in the pre-market live streams, one trade is all it takes to blow up your trading account, but one trade is very likely not going to make your trading career. So make sure that you have longevity in this game here, right? Anyhow, these are the reference points. Those are the downside levels. All the same concepts apply as the S&P. If we open in range, look below and fail back in range over the August 5th low, I would look for upside towards Friday's high. If we get over Friday's high, I would Brigade bolt through the gap range overhead. When we get there, very possible for a lower high to form. I would probably start re-entertaining shorts on the entrance back inside of Friday's range here and the loss of 440.50. If the market is going to turn into a big bottoming structure here, then ultimately what you want to see is either a lockout rally that just straight up gets above the previous breakdown point up here. That's the weekly shelf we were just talking about. 465 is roughly that zone. You want to see this, or you want to see this over time, and then a Brigade bolt over a higher low double bottom. That starts to become a little bit more enticing. So let that structural low play out. I would not just try to willy-nilly catch the falling knife here. We are open-minded to a capitulation-style V-shaped recovery, but it requires either a failure pattern off the low to get involved early, tight risk right under the low, looking for this. We will still reevaluate for a weekly low or high up here, or it requires a divergence at the internals level. Quick check-in on the hourly chart. Again, there's really not much to say here other than just into the end of day. That weakness into the close, it's pretty telling that to me it seems as though things aren't quite done yet. It seems as though the selling can extend on the Monday open as the panic sort of ripples out into the less... What would you say? People who aren't watching the market every day, those people, they're going to get the wake-up calls over the weekend, and they might have something to say about it. Hey, call up, Uncle John calls the broker on Monday morning and says, whoa, things aren't going so well, sell it all. That's a Monday morning order, and you see something that continues to extend the losses, right? So it does seem as though there's still room for some downside here, but I would start looking for those failure patterns. I would start looking for that divergence to really come into play for a potential V-shape style recovery if that lockout is going to come in. Here's the anchored VWAPs that we set up, so we may as well use them. Making confluence at this as the week goes on, absolutely. That's from your Wednesday level, and this one here from the Monday session is at the top of the gap and the upper edge of the weekly expected move. As we said in the S&P 500, there's easily, I shouldn't say easily, but with the capacity for further downside, I would say that any rally lower highs, intraday lower highs that reject somewhere around 430, 475, you could start looking for risk reward back to Friday's low. If it turns into a double bottom, then fine. We might entertain that if there's divergence at the exchange level. If we go through, Brigade bolts underneath Friday's low, the August 5th low at 424.75. Like, let's go. There's nothing wrong with risk reward into the next levels, 414.50. Then the all-time high, previous all-time highs at that 2021 level at 404.50. All right. So that's it on the NASDAQ. It's the technicals usually require having a little bit more, at least in terms of this scale of technicals, having a little bit more candle structure to play off of. So we'll use these levels. We'll take them at face value. We know that the bearish trend is clearly in force. We know that at the exchange level, let's go to the NASDAQ side, just it's the same comment, right? Huge volume outflows Thursday and Friday. This is easily starting to get towards that capitulation. Look at this. Out of the NASDAQ, can we actually throw the NASDAQ into the index watch? I'm just curious if we go N for NASDAQ composite, do we get the N NASDAQ 100? That's what I'm looking for down here. Yeah, 99 to 2. 99 to 2 out of the NASDAQ. So once again, is this capitulation, is this correlation? Certainly getting close to it, and it feels as though the worst of the volatility is behind us, and we'll start watching for some of this structure or divergence to improve if there's going to be a V-shaped recovery. So there's nothing new to really reinforce out of the internals, out of the NASDAQ side of things. Let's jump into the market profile for the nasty NASDAQ, and as we take a look here, the biggest difference is just noting that the value area of point of control did not slam themselves lower into the low of the Friday session, and instead is slightly higher. So if the NASDAQ ends up opening on a gap down, gap fill reversal could be a play, or a point of control rejection here. So you go back, you tag up to it, then you look for some sort of short back underneath Friday's low. That could certainly be a trade outcome worth playing for. The only time in which the squeeze would be a little bit more impressive to the upside would be if you open over the point of control support off of it and then move through, let's just say this is Monday, the opening print, that starts to set up at least a scalp up towards the Friday high of day, right? So that is your NASDAQ side of the market profile. Let's jump on into our last, but certainly not least, broad market index, the IWM. Let's go up to a monthly time frame chart just to check in on that April range so far. And what we'll find is unfortunately the worst case outcome. Why do I say worst case outcome? Because this balance range, if this is going to act as like building blocks in the upward direction, you don't want to fall back into block number 1. You want to stay in block number 2. Clearly underneath the monthly 50 SMA, and it's not just like it was a surface scratch, like a little bit of a move here and like we just closed out at the edge. We're like at the midpoint, if not gunning for the bottom end of the range at this point, which is just not helpful for the monthly bull case that we were trying to continue with the idea of lows, higher lows, maybe like equal lows, trying to give the market the benefit of the doubt. No dice there underneath the monthly 50 SMA. Monthly trend is neutral at best here. And obviously, the pattern traders are probably shouting through the screens already, it's a double top. It's got to be a double top. We'll wait for that. When and if we take out these lows, then yeah, duck and cover. Way, way uglier for the S&P as a headwind, certainly if that were to become the case. Let's take it one step at a time. Let's go on down to, and there's no confluence level to be thinking about here. This would have been your 2022, 2021 highs. Not there. Sorry, small caps aren't really helping the case for that S&P overall recovery, right? And this, of course, is concerned from the growth perspective. So that's that. Let's go on down to the weekly. As we take a look at this candle structure location, it's all the same. It's underneath the previous cluster of lows in here, lower high, lower low, strong close from the sellers, smack on the bottom of the move here. I would also point out underneath this weekly area of support, thin structure retracement should bring prices where? Look at that, right back to the breakout level of the inverted head and shoulders. That's what we tested. That's where the lower wick is coming in. If we go below that, things start to get more dangerous towards the bottom end of the monthly range that we were just talking about. That's closer to 165. If there is a counter trend rally here, there's nothing that's going to change the weekly trend unless you get a weekly bullish engulfer that looks like this. Let's say that Donald comes out and says, you know what? No more tariffs. We're going to zero on everything. Let's say Jerome Powell says, great. We're also going to say interest rates are going to zero, and we're going to fire up that money printer and just print away. Maybe. Never say never, but I would certainly argue there's lower odds of that at this point, and I think you probably would too. In terms of lower highs, that's underneath 200, which unfortunately on the weekly time frame chart, monthly time frame chart, rally, rejection, lower highs, you can't, there's no bullish spin for the small caps at this point in time. I hate to say it, but there just isn't. Obviously, from a fib perspective, your 38.2 is probably mixed somewhere in here. Let's come in from the all-time high, though. Quickly check that. Yeah, right at the bottom end of the range. We could also come from this lower high right at the bottom end of the range, really not changing the idea that a 200 rejection off of previous structure keeps the bears in control. We could look at the anchored view apps for the small caps because they're slightly different. And if I actually grab a little bit more time here, this will accommodate the previous all-time high and this low. We're underneath all of it. And once again, rally, retest, rejections, lower highs, it's bearish across the board. Doesn't matter how you slice the cake. Let's take a look at IWM on a daily time frame chart. You have much more of a hammer-esque bar on Friday relative to what we had in the NASDAQ and the S&P. And this could be, keyword, emphasis on the could be a subtle divergence that at least suggests that it's possible to close the gaps, or at least maybe the open's not going to be as bad as we think on the Monday session for the S&P. I wouldn't fully subscribe to that theory, but generally this stepping up at the neckline we just talked about from the weekly point of view, it makes sense, and a classic daily hammer would mean we probably want to look for longs over the high. In this case, we have a clean gap close overhead, so hourly structure or 5-minute setups, 2-minute setups that allow for this out of small caps on Monday. Over 184.15 closes the gap 189.10. It might be worth entertaining as a possible long idea, which would alleviate some short-term pressure in the S&P 500. So carrying that forward as a nuance. If we just consolidate in here and start to drift lower, yikes, big gap to close underneath. That's going to act as a black hole magnet. Underneath 174.25, we get swallowed up to 169.75. Ugly, ugly, ugly. If the market is going to produce a stronger bottom, again, all the same comments as to what we talked about in the S&P and the NASDAQ. If we do something that looks like this, I would still be open-minded to big lower high rejections here. That's that monthly key level. It's the weekly, right? It's that 198. I would need to see like a higher low pullback from that. Then this turns into a double bottom. We get over the neckline. Now we can start talking about a structural low. This is like weeks away potentially. If there's a V-shaped recovery that looks like this, and then we get a higher low above, maybe we can have the conversation. But once again, what do the probabilities seem to suggest? Seems as though that is a lower probability outcome at this point. We will change our tone when the time is appropriate. Let's go on down to the hourly charts. Really not much to talk about other than the fact that, okay, on the Friday session, a little bit more so sideways than the S&P, which certainly got, and even the NASDAQ, right, got some follow through into the afternoon after the Jerome Powell commentary, with the very weak final closing hourly candle closing dead on the lows of the move. Not quite the case out of small caps, which gives us that daily hammer candle divergence anyways. There's your daily superimposed structure. So not much to really talk about here. Over 179.25, the consolidation is neutral. I would treat this as a balance range and then just say balance rules in place. And we know that the upside kind of plays nicely with the hammer and the structure we were just talking about. So that's really it out of smalls. Let's take a look at the intraday anchored VWAPs. The entire cluster is down, of course. Not great confluence at the top of the gap, which is fine because we closed a little bit more centered instead of pulling that VWAP lower via a lower low into the afternoon. So I'd be mindful of it in the gap range if that is going to play as an upside trade, but not overly concerned about these here. I would primarily be gap fill reversal, lower high happening here. So just to simplify the trade pathing, right? Then this would be top of mind for a rollover. Let's say that we go through it all. This is like huge lower high, ding, ding, ding. Alarm bell should be going off in your head. Where's the lower high? If we just get consolidation and Brigade Bolt here, remember the gap close and the black hole underneath us is sort of the target there. 174.25 down to 169.75 is the number. Let's take a look at the Russell side of the internals, just at the not exchange level, but index level. Big volume outflows. It's just the same conversation we've been having recently across the internals dashboards, even with the subtle divergence just relative to the other indices going sideways on Friday. You still didn't preserve any like it would have been much more impressive if the volume flows were not substantial to the downside, if the advanced decline line actually made a move to the zero mark, if on Friday the cumulative build ended slightly positive, right, on the sideways action. You're just not seeing that here, even at the internals level. Let's go on over to the market profile for the Rusty Russell. A little bit more of a balanced session. You can see that based on the normal curve here. Let's try that one more time. The normal curve in the distribution, the point of control literally almost at the midpoint. The purple or blue line, depending on your screen there, is half back. So value area point of control towards the center, decent excess high, decent excess, very good excess low actually in C period. It seems as though if there is a place to look for a counter trend move, small caps could have already been dealt the blow. And if we just think about this logically, let's go back over to maybe the higher time frame daily chart out of smalls. I mean, the S&P is on a relative basis, right, maybe somewhere in here in terms of its sequence to the downside, right? The S&P certainly went much more so sideways. It started to break down, and then there's now like this big leg to the downside. Small caps have already experienced leg 1, leg 2. This is leg 3. Not to say that like I'm pounding the table for small caps to rally and oh my goodness, they should be at all-time highs. But if the damage has been dealt, if this has sort of been priced into its extreme already, maybe the small caps are the place to start looking for any signs of a recovery. So there's something to think about there in terms of the relationships between these things. All right, let's get on over to, we already talked about, let's get on over to sectors. Let's talk sectors here. Losing track of my analysis, it's so volatile out there. Sectors, weekly performance. This is kind of a funny list because the way that Thinkorswim is not so smart, and it likes to put anything with a 1 it thinks is very low, and anything with a 9 it thinks is very high. So at the bottom end of the barrel is technically at the top end of the list here. We have our XLK down over 10% by a hair. That, of course, is bearish. The XLK is the heaviest weight risk on sector, so that does not jive well for a big reversal being put in. Semiconductors down 12.8%. Again, another risk on component of the marketplace, heavy weight for the technology sector. That's not good. Energy really getting brutalized here, down 14.6%. Another indication going back to that conversation about growth scare. We know that the GDP forecasts for Q1 of 25 are ugly, but to see energy and crude literally falling off of a cliff, breaking out of its sine wave channel, not good. Really not good from a growth perspective there. And if that is slightly deflationary, which helps the Fed out and maybe brings in lower rates, but again, lower rates for what reason? Not to stimulate the economy because growth, right? That's like recession talk, not like soft landing talk. This is, oh my God, we have to panic and let's stimulate so we don't fall into a deeper recession and the unemployment rate goes through the roof, right? So it's potentially defensive in mitigation of the jobs report, which so far has come in strong, and we'll take a look at that momentarily. But let's continue along here through the data points. The next worst would have been financials, down just shy of 10%, down 9.28%. The conversation here, I think, broadly speaking, if we go back to the idea of capitulation versus or capitulation and correlation being tied together, this is correlation. There is no sector rotation taking place when everything is red on the market minder window here, and the only green thing is the long bond, the TLT, up 1.78% because, of course, the market's concerned about recession and rates are going to need to get floored down to zero. The bond gets bought up, right? So there's sort of that flight to safety taking place as the only green spot on the market minder window here. Amazon, a subtle outlier on Friday's performance, which we'll get to momentarily. But structural charts, let's dive into it because from a trend point of view, a lot of damage. A lot of damage has been done. No longer are we just like, okay, maybe this is an equal low to back here. Maybe it's an equal low to back here. Lower low, no matter how you slice the cake, means that any rallies can be met with lower high rejections, and it's very difficult to say with confidence that the trend has changed until you have some sort of reversal pattern. If there is going to be a V-shaped recovery, the first good sign of that out of XLK would be acceptance in Thursday's range and probably gunning immediately for the gap close overhead from Wednesday, right? Wednesday afternoon to Thursday morning, you would want to see that gap close sooner rather than later. If the market just dilly-dallies down here, looks into the gap and fades back off to the downside, it's not really a sign of confidence that, oh my goodness, we're out of the woods and it's time to rock and roll to new highs. What we do have to do with these charts is bring out like 4 years of price data just so we can get a sense for what the next downside levels look like. If we breach this level at 181.25, expect a thin structure retracement. There is no volume support in here until we get back down to the double bottom neckline at 172.15. Beyond that, your double bottom lows are at 161. I'm not calling for 161. I'm showing you the areas that we have as reference points if the market continues to extend the losses lower. Let's move along. So XL, and clearly from a technical point of view, the candle structure here is hideous. We've closed on the lows. There's nothing bullish to say about this unless we have those two things that we've talked about. And I hope I've been very clear about that, right? Number one is a failure pattern at the lowest low, or number two is a divergence at the exchange level. We'll also talk about a volatility, a VIX divergence in just a moment towards the end of the supporting evidence analysis. But if you have one of those two things, then fine, maybe there's a counter trend move available there, but I've been very careful with my words, as we have been for the last couple of months. Counter trend rally, right? This is not a bottom. This is not a, oh my goodness, new all-time highs. This is a counter trend rally until proven otherwise. So that's that. Let's move along. Semiconductors, rinse and repeat the same conversation. What are the downside levels that we can at least acknowledge? Top end of the breakout point and then the bottom end of the support. You could think of this as a pretty clean, actually, Brigade bolt over previous resistance, then acting as support over the daily 50 in blue. That's 164.25, 176.25 upside gaps sort of speak for themselves. 190.50, 195.15, same commentary as the XLK. Energy zoomed out here. Take note that energy, this is the sector level analysis. We'll get to crude in just a second. Here's the sine wave channel that I was just referring to. This is an aggressive breakdown. When did we have another scare about growth? Back here, right? Excuse me. Global demand for oil was like, whoa, what's going on, right? After this big, this is like inflation, and then, oh my goodness, right? As rates lift off, right? And as rates lift off, it's like, wow, you're going to choke out growth. No surprise that energy comes down as growth is coming into question. You can see the same, you can go back to other, really much more historical references as well and take a look, but same comment over here out of crude. Crude is not even just, let's clear this drawing set actually, get those boxes out of the way. It's not just at the bottom end of its trend channel, but it's actually breaking down underneath a multi-year descending triangle. So growth concerns, yeah. How about yes, ding, 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 winner, winner, chicken dinner. CL, done. Let's move along to XLP. What's going on with consumer staples? This is a defensive sector. How's that performing? Well, there's no hiding. There's no hiding. We're coming into an equal low, which is a little bit more compelling for like, okay, it's not that bad out there, but you would think if the market's still in its rotational phase, you would think that this would have held up here. And like, fine, there's all this panic, but people are still going to need Band-Aids from Johnson & Johnson. They're still going to need their soap from, Unilever or whatever. People are going to still need to buy these things, recession or otherwise. No hiding. So the consolidation did not persist over 81 nor 80, and it just continues to look like a bearish data point for the market. Utilities, a little bit more D for defensive, the most bond-like sector in here breaking down a little bit. Just, again, no hiding seems to be the theme here. You can see on the initial response or release of the tariffs, right? not really wavering all that much. Same thing, same comment actually over on the XLP. Let's be a little bit more pointed in that analysis. Thursday was the day that the market was first responding to the tariffs, and oh my God, like this is horrible. And notice that staples actually were acting defensively. It's the Friday which gets us closer to that capitulation argument, which I've hopefully been pretty clear in through today's analysis. So there's that. Let's take a look at consumer discretionary. This goes bye-bye in a recession. You don't need to buy a new Tesla in a recession. You can use whatever car you've got. You don't need to buy a bunch of nonsense from Amazon, comes to mind, being in consumer discretionary, right? The products, right, will be fine. The consumer staples products that you order from Amazon, but Amazon itself, maybe like AWS servers, and we'll talk tech as well. Maybe that gets a little bit of a back burner, right? Tech gadgets. Think you don't need a new Apple iPhone, you don't need a new MacBook, you don't need any of that stuff in a recession, and therefore your XLY takes a bit of the brunt, right? So not a shock to see this. What I find most compelling about it, actually, for further downside early this week, is that you did get a gap fill reversal. You got a gap fill reversal on the Friday session. The market rallied a bit off the open. And again, you can see that little sweet spot here out of Amazon, 2.31%. Intraday, it was up over 6% from the opening print. But what happens into the close, we fade and close underneath the low of the opening print. So do we really have a firm bottom being put in place out of tech or let's just parse this out to Amazon? No, absolutely not. It does not seem so. It would seem like this is nothing more than a bear flag breakdown with the potential for a lower high here to extend losses further. Downside references, this gap back here, the breakout point, and then the low, we have 180.30 closes to 178.60, 174.50, then 167. 167, the major low from this pivot here. Let's jump into healthcare, another D for defensive sector. Friday, there's no hiding, but Thursday, there you go. There's your defensive action inside of the consolidation, if you will, for the head and shoulders. But nonetheless, the market broke from the head and shoulders, and therefore lower highs are still on the table. If this is going to be defensive and rally a little bit, I would primarily be interested in looking for a lower high underneath 140.80 coming from this historic inflection point, right? If you're underneath that, you're well below the neckline of the head and shoulders, and the bears are probably looking for a lower high, equal low reattempt, and we go beyond that into 132.50. Let's move along to real estate, getting bludgeoned on the Friday session there. Nothing to really talk about out of real estate. I find it kind of comical. There's some conversation that like, oh, this is just 4D chess. They're going to bring interest rates all the way to the floor. They're going to refinance commercial real estate, and then they're going to say, let's go, right? It's tariffs are off the table, right? We forced this recession, whatever. As of right now, real estate not really looking so hot underneath the 41 level, but at an equal low. Hard asset, D for defensive, a little bit. I wouldn't really look at this as being a major player in the analysis of what's happening sector-wise for the S&P. Materials getting beat up. This is a no-go. What I do find interesting is that the XHB had a bit of a rally on that Friday session. This possibly comes from Jerome Powell acknowledging in his press conference, as well as rates obviously coming down. That should speak for itself, but acknowledging that we have a shorting housage always, and we need to build more homes. So not saying that Powell directly caused this move. Of course, it's probably much more tied to interest rates, but I do find it interesting that home builders rallied on the session. You could even use ITB if you don't like the S&P version. Take a look at ITB. It's the same thing. There's still a rejection off of the previous support, and we would need to see sustained improvement over that level. But the fact that it rallied in the face of a blood red market, a little bit of an interesting shining diamond in the rough, if you will, for the market. Let's continue along though into our communications sector. Unfortunately, right, if you want to parse it out, it's such a small sliver percentage-wise of what actually comprises the S&P 500. Yeah, it matters for the cyclical side of the economy, but your tech sector, your discretionary, and your financials, that's either going to make or break it, right? Communications, big new lows breaking down on Thursday, lost the daily 200. Big retest of this area. I wouldn't be shocked to see if we get a Brigade bolt failure underneath the Friday low back over 87.82. Who let that fly? Oh my God. Let's go 80 flat. Round numbers only. You guys know the rules. Look below and fail higher low over 87.80. Could start to come up and test that gap. That would be interesting for an upside counter trend move if we're just dribbling down into here. It's bearish. I would mind my trade location. I wouldn't really want to be short new money shorts inside of this range, especially given the context of how we've arrived at this location. Industrials getting beat up, not a shock. What do we see here? There is your previous retest, no support, and we've gapped and gone straight through the consolidation range. This is nothing but a thin structure retracement into the previous breakout level at 114.25. I wouldn't think that there's anything to really do here until either we get a lower high rejection here and continue, or we get acceptance here, and then we could trade for a Brigade bolt through the range to pressure this 125.70. So watching that out of industrials, it's a possible trade idea. I like the way that this level can be used as a reference 120.25 for the upcoming week. Financials, ugly. And one of the things that I particularly don't like about this is the fact that we're coming into financial earnings this week. Friday really kicking things off with JP Morgan and Goldman Sachs. So why is this concerning? Whenever the markets sort of fall into turmoil, you've just got to sort of think about the risk of a financial crisis. Not saying that this is the great financial crisis or that it should even be compared to that, but let's just say that things start to go poorly in terms of financial firms kind of blowing up in the face of this volatility. You could equate it almost more so to what happened with SVB. It's not to say that we have a financial crisis that's going to wipe out the housing market. That's not the comparison, but rather, are there insolvency issues with the amount of volatility that we're seeing? That's something to be concerned about, and obviously financials are responding to that underneath what could be called a classic head and shoulders formation. So the fact that we're underneath this, the fact that we're underneath this, the fact that this is like exactly where we've closed, show me a lower high here, show me a lower high here, bank earnings don't go well, we get another gap down, spells trouble for your S&P 500. You could be a little bit more optimistic and say something like, what if bank earnings go great, Matt? What if we're out of the woods here? What if volatility is in the rearview mirror, as you've been saying a little bit here with capitulation already taking place? Well, if that's the case, then let's get something that looks like this. Let's get something that moves into this gap, and then please, let's get back over the neckline here. If you could show me a higher low over the neckline, then great. That starts to become a little bit more comforting for the possibility of a stronger structural low being put in place for the market. TLT speaks for itself. We know that rates are on the decline, basically, so TLT is moving higher. Not a shock here. It did fade a little bit off of the open from the Friday session. That's fine. I think that the open there was really a response to the overnight headline from China, right? Hey, we're going to give you back reciprocal, quote, 34% tariffs. Crazy. That is our sector watch. Let's quickly go through the sector ratios now that we've covered the structural charts and sort of have a grasp for where there's nowhere that looks good, if I'm being quite frank. The ratios, let's take a look. Top right-hand corner, if you're not familiar with the ratios and how to set this up, you can take a look at the tutorial. This looks risk off. This honestly doesn't look as bad as I would have thought. Discretionary here. So I'm going to go ahead and put a neutral indication. I would still like to acknowledge that, yes, it is bearish. It's in a downtrend. There's an opportunity for a lower high. But given everything that happened on Friday, the fact that this actually produced a higher high in the ratio, that's something. That is something. This is D for defensive. I'm not overly concerned with that. Financials breaking down here gets a little bit more of that wishy-washy. So I wouldn't say that this is as bad of a risk-off look as what we had earlier. It gets us closer to maybe being at a capitulation low. This, unfortunately, is like, wait, hang on. Did you just say it's not risk-off? Because, yeah, it is. Look at consumer staples, higher, right? Look at utilities, higher. That's risk-off. If we look at the specialized ratios, this is risk-off, 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 and risk-off, no matter how you slice the cake. So the XLY small little green spot there, it's one data point across how many things have we looked at so far that probably align more so with the bearish thesis, the bearish narrative continuing to play out, the structural level still being in play. One data point, right? I would continue to remind folks of that, not lean into it too much. Let's get into, in terms of risk on, risk off. Let's look at gold. Big break to the upside here, even as gold is pulling back. That's just obviously because gold came down less than the S&P did, but that's still sort of a flight to safety indication. Gold breaking out on the ratio here, it's a safe haven asset, which we would say the same thing about treasuries, right? The long bond. If we look at the TLT, look at the ratio here, big spike to the upside. This looks like risk off, lower appetite for risk on in equities. And that has not changed. Like, if anything, it's getting even a little bit worse into the Friday session. Now, if this collapses and we get acceptance back down here and this rallies and this sort of does this, then like, fine, maybe we have that capitulation low, the V-shaped recovery, but we're not there yet. I would not stick my neck out on the line and say like, it's time to go all in. Hence Well, in the monthly time frame chart, I said I deployed 10% of available cash, and I'll be holding tight until 480 to deploy anything else on the downside. Let's take a look at, let's move on over to the Dixie now and see what's happening with the dollar. Dollar got a little bit of a rally here, which I find somewhat interesting on the Friday session. If we go to the daily chart, you can see that the dollar moved higher. That might just be a classic indication of flight to safety as well. If you think about, like, obviously the bond would be a little bit better than just going straight cash, but if people are getting into the dollar, just selling, obviously you could think about it currency-wise, or you could think about it like, hey, let's get into dollars, US dollars. That's a little bit more defensive, right? So that's kind of an interesting interplay of what's happening over here on the Dixie, and we'll continue to keep tabs on it. If we look at the TNX, which is the 10-year yield, breaking down, we've cleaned up the chart and we're just tracking the 4% mark at this point. You could probably, from a technical point of view, start thinking about this also at 4.145, 4.15, if we will. Any lower highs underneath that on the rate probably continue to play out from, like, from a technical point of view. There's your classic head and shoulders. You would just say that bonds are getting bought over the neckline, basically. So that's still in play. It would be a Brigade bolt out of, if we just go here real quick, let's go ZB for the long bond, and you can see it's the same formation here. And if we got a Brigade bolt, that's the same thing as interest rates staying underneath 4.145 or whatever we just said, right? So that's that pattern. Let's check in on the inverted ZT, see what's happening with the 2-year, the short end of the curve, falling off of a cliff. And as we know, if you've been tuning in, we've been tracking very closely the Fed Watch tool. So looks like it gave a little bit of a reset in the background. Apologies for that. I like to have it preloaded, but nonetheless, we are still able to navigate this just fine. The odds, first of all, have dramatically increased for a potential cut in the next meeting, which is going to be in May, of course. And then we have 1, 2, we have 3, and then 4 rate cuts being priced in for 2025, which is not in alignment anymore with the Fed's 2 from the SEP. Why would the market be pricing in lower rates? Because the market is scared, use your imagination, of a potential recession, right? Scared blank. And that's clearly being priced in. This is the growth story. This is the crude that we just saw. This is the market selling off hard on a number of different catalysts and concerns that it has right now, right? Let's take a look at GDP now. If you want to talk about growth concerns, here you go. Atlanta Fed Nowcast says currently looking at a negative, where is it, 2.8, negative 2.8 on Q1 GDP. That is downright ugly. Downright ugly. If you want to use the gold adjustment that they've just included in the most recent forecast, we're talking about, where is that? They have it included in an actual level up here. They don't. Adjust for golds. Here it is 0.8%. Oh, I guess that just is it. I didn't realize that we were over the negative. Okay, there you go. Negative 0.8. So that is that. And remember, what they're trying to do here is they're trying to account for the trade war that's happening and the export-import that is just going to get totally thrown out of whack. So I don't know that I wouldn't align with that fully in terms of using that forecast. The alternative model forecast, as they call it. Let's take a look at the calendar. What we got last week wasn't all bad. I would say that the JOLTS number didn't really shake the market all that much. If we look at the ADP non-farm, it actually beat the expectations. That's a positive indication from the labor side. Obviously, we had our tariff announcements. And then what I think is maybe a little on the concerning side was the services PMI, if we're thinking about that growth story again, at the 50.8 on the release. Their forecast was for a 53 flat. That miss is sort of concerning. But then, again, back on a positive note, the labor report, I would say, was like pretty solid. Pretty solid here with average hourly earnings not indicating a wage price spiral, way better job growth than anticipated, 228,000 versus 137,000 on the expectation. Previous was revised down, however, to 117 from 151. Even if this gets revised down, it would have to be a nasty revision if we're going to go, well, firstly, under forecast, but never mind negative, right? Unemployment rate, small uptick here. I don't think anybody should be surprised by that, given what's been happening over the last little bit. If we go to the weekly jobless claims, small uptick off of these lows, but nothing that's breached up and over 250. I would just remind folks that when and if this breaches, whatever the upper limit might be, when the Fed has to respond to bad incoming data, that's when it's already too late. So the uptick here is like, let's keep a very close eye on that, basically, from a from a Fed Watch, fundamental data watch perspective. And what we could also do here is bring out the SOM recession rule. If we do this, where is that guy? It's in here somewhere. Unemployment rate, we'll have it attached. There we go. So the SOM recession rule, this is the uptick to the 4.2 that we just got. Where's the white crayon, please? There we go. And the SOM recession rule has gone flat. Remember that as this untriggered on this move back down, it actually gave a stronger reset opportunity to the SOM recession rule. Basically, it looks at the rolling, I believe, and don't quote me exactly on this, but it's the rate of change of the last 6 months in the unemployment date and whether or not we've exceeded a certain threshold. Then it will trigger up and over the 50% mark, right? So that has not triggered and would certainly fall into the okay category. The jobs market, I think, is fine right now, but it's more about that growth. And if the growth recession is the fear, the labor market will eventually follow. Like, I don't think that these two things are not independent of one another. If there's a growth recession and people aren't spending, and then we have to resort to layoffs so companies can improve bottom line, you're going to get that nasty not so virtuous cycle to the downside. Anyway, that's a little bit on the fundamental front of last week. Let's take a look. And of course, if we want to follow up on last week as well, hopefully you've looked through this. I'd say that the biggest thing we've been dealing with is the China tariffs here, and just generally upsetting a number of trade partners. I'm not here to argue like what we should or shouldn't do. I'm here to just like make money from the market and analyze this as objectively as possible. What should we be thinking about? The market clearly doesn't like this. And again, air quotes, you could say it's right or wrong or whatever. It doesn't matter to me. Upsetting trade partners, closing off global trade, in theory, raises prices at home for us, as well as our exports are probably not going to be well received, right? So generally speaking, the growth concerns, I think, come from this as well, or this is a further stoking the flames further of the growth concern. So anyhow, if you haven't seen the tables, you should go read through them. And I think the most notable part of all of this is just the magnitude of what happened here and what was being reciprocated, because it was not the outright tariffs themselves. It was some calculation of the trade deficit between countries, right? So not here to have a political conversation. Obviously, the market doesn't like what's going on, and we'll leave it at that. As we look forward to next week, we have some Fed speak coming in here early on, but pretty quiet, I would say, honestly, in terms of big announcements. Things really start to heat up. FOMC meeting minutes probably won't even be a big deal, given that the market's flipping and flopping over other things right now. But this, Thursday, April 10th, is where we start to care. It's the CPI print as well as jobless claims. Thursday morning, 8:30, we will have coffee and donuts up in the penthouse office for that morning's release. Let's take a look together. Thursday, April 10th. Next, inflation data will come out, and then PPI, of course, will follow it up. Preliminary consumer sentiment and inflation expectations on Friday, always more important than the revisions. We'll keep an eye out for that. As we take a look at the earnings calendar, forget about everything early on in the week. There's really nothing here that we care about. I would say it's all about JP Morgan. It's all about BlackRock. It's all about Wells Fargo, Morgan Stanley. Bank New York, we'll give them a pass for now. Really, JP Morgan. It's the heaviest weight constituent outside of Berkshire in the XLF. So, JP Morgan, top watch, earnings coming up. We do have this pulled up as well. I think that this ties into the capitulation narrative that we've been talking about here, which is just that the market does seem to be at a point where it's almost as though the air quotes worst of the volatility is behind us. I'm not necessarily saying that it means doesn't mean that the market can't go lower, but in terms of the magnitude of the intraday move, and we've given you a number of tools to look at this already, and we'll talk VIX in just a second. If we're inside the weekly expected move and we don't breach it, I would start to think that the worst of the volatility is behind us and the extreme fear gauge starts to move closer to just fear, right? It doesn't mean that the market needs to rally and go back to all-time highs. It just means that you're probably not in the throes of just wild, down 8%, up 5%, down 10%, up 13%, like craziness, right? Let's get back on over to the platform here. Let's finish up the analysis through our additional indications. Let's look at bonds relative to themselves, just noting here that the short end of the curve is making the most rapid response right now. And that, of course, is because of the way that Jerome Powell has remained somewhat firm in his stance there. Let's take a look at, as in not doing the emergency cut that he was asked to do on the Friday session. Let's take a look at credit spreads. These are almost moving off the charts, quite literally, towards the upper bounds of what we have here in the chart windows. that's a risk-off indication. So once again, it seems as though like we're getting close to capitulation, but for now, until these things start to dial back a little bit, you can see August, right? There's a spike and then down. We're actually over the August 5th panic low in terms of credit spreads on both sides. So one more time, we're not out of the woods here from a vol perspective. This is still looking fairly ugly. Let's move along to the junk bond in isolation. Looks horrible. What doesn't look horrible is the LQD, which is corporate grade. And what you'll notice here is actually a bullish divergence. Now, again, not to say that this is like going to call a market bottom for us, but if this were to break out up and over these highs, and we saw a failure pattern at the lows or a divergence at the market internals level, that could be a helping indication. We'll watch that closely out of the LQD. Let's jump on into the Bitcoin chart, which has oddly been a little bit strong relative to what's been going on, especially noting that Bitcoin, and go back and you can watch and hear my interpretation of Bitcoin until time's end, but I've always said, and some people disagree, that Bitcoin is a risk asset. Until proven otherwise, until you can exchange it freely and use it to buy groceries and you can send, until it's a wide mass adoption, its value proposition is like, okay, it's an unconfiscatable asset, and even there are some arguments around that. But really, it's the idea that it's maybe I can sell it for more in the future. Maybe it'll appreciate in value. Therefore, it is a risk asset. It is not defensive. It's not like there's, I don't know. It's not a get out of jail free card. Basically, is what it seems like to me. So, with that, I would just reinforce that it's funny to me that this as a risk asset didn't break down and follow suit with what happened here in the S&P and even the NASDAQ, right? So a feather in the cap for those who say it is a little bit more defensive or like it's an inflation hedge or whatever, but it didn't budge. It didn't budge. There was no rotation back down to here. So that's an interesting data point that I would carry forward as being somewhat substantial in the analysis. Let's move along to the breadth and note that it has just terrible. Fallen off of a cliff. This is a bearish data point. There's really not much in terms of recovering from this, at least in the short term, right? You would need to see some sort of major move back over the zero mark, which just it's not going to happen, right? These are new 52-week highs versus lows in the S&P, or on the NYSE exchange, I should say. And until these bottom, until the S&P starts getting back over 50 SMAs across the S&P 500, this is the SPX A50R, right? Not the NYSE. Until that happens, this is a pretty painful looking look out of breadth itself. You could see that out of the RSP. You could see it falling off of a cliff here. There is no divergence, right? It's not like, hey, we found support at previous level and like things are all fine. This August 5th low just obliterated, as was this, right? So no safe haven in terms of breadth. NASDAQ equal weight, same commentary. Dow Jones Industrials versus Transports, same commentary. Even with the transport signaling a little bit of a wick, the industrials look pretty weak as of Friday's close. Now we can talk volatility. Volatility broke out up and over the 40 mark, which starts to get us closer to another capitulation style indication. But one of the things you can watch intraday is for a divergence between vol and the SPX. What I mean by that is if we just drop this down, let's go to a 5-day, 5-minute chart. This will look a little bit funny because, of course, down here, I'm going to go VOO just because it's a clean enough drawing set, but it will have the after hours on it. Not quite the same as VIX, of course. Anyway, point being is on the intraday, let's zoom into, I suppose, just the Friday session here. As the S&P was moving lower, if the vol index was also moving lower, you can see as it bottoms, this is where it moves lower. But let's say that this, as the VOO was moving lower, S&P was moving lower, if VIX was making an equal high, if not drifting like this, that would be an indication that you have a volatility divergence, and that's where I would actually try to start buying the failure patterns out of the S&P down below. So again, the point is if the S&P moves lower and volatility is also moving lower, that's a sign that the worst is behind us, and we would look for a failure pattern to get involved on the long side of the market. Another thing that you could do here, although it's not going to be so easy, depending on your time frame, is you could look for a divergence in terms of equal high, lower high. From here to here, let's start with the lows. Here to here, you made a low, you made a higher high out of the VIX. Here, you made an equal low. Here, you made a lower high. It's a start, but this is not a failure pattern, right? There's no failure where you started to find, if I do something that looks like this, back over this, where's the higher low, right? This starts to maybe look like it, but as you break back down underneath, sayonara, equal high, lower low. So you really need a strong divergence. And again, this is where it gets tricky on the intraday. I would want a better failure pattern with a previous day's reference point. Relative to this, maybe like fine, you could say that was trying to get acceptance back above the previous pivot. But I would really want to use a previous day's low, which is what we outlined on the SPY daily time frame chart analysis just moments ago. That was coming up on like 40 minutes ago now, Matt. Let's jump into the VVIX. Moving to the upside, obviously telling us that volatility is rocking, not a shock there. What I find also compelling would be a move from the one-day VIX back to the bottom end of the move here, or the channel that it trades in. You can see after this, it was it. That was done in the August 5th panic, right? If this comes in aggressively, if we start to see a red day to the downside, which we will, right? This does oscillate to some degree. As in if red days are found, it's probably going to speak to a sideways market at least, if not maybe the opportunity for a little bit of lift. If you look at the 9 versus 30 day, deep backwardation happening here, deep backwardation happening here. We're at the peak of madness in the volatility side of the equation. If we open up the volatility curve, it's a very smooth backwardation. Remember that contango does this. When and if the vol curve reinverts, that would be another indication from a volatility perspective that you could say, okay, there's a divergence here. I would want to start entertaining the long side a little bit more so, right? So this vol curve is useful for identifying when and where a bottom might emerge. Let's finish it up. Let's finish it up on a strong note. Let's rip through some of these charts. Obviously, there's going to be a lot of damage done to them. So we're exploring new levels and where those reference points are. Obviously, a lot of these charts are bearish. We'll point out when and if there's anything bullish or noteworthy for a potential upside move here. So NVIDIA coming back down to this low at 91.75. Upside level, gap close overhead, obviously, from the Thursday into Friday session. And then this is your major watch. Lower highs at 104.75 set up risk reward back to the downside. And ideally, the trend would just be continuing, looking something along these lines here. If you get straight up continuation, be careful of new money shorts into the lows. This is where a snapback rally will take your head off if you're late to the party at the worst possible trade location. The next trade levels will be at 88.15 and the bottom end of the consolidation at 83.50. This breakout level here, which was retested for a higher low, is 74.50. Those are the numbers. I would treat this chart with a little bit of caution here, right, with the downside from Friday. Let's go to Microsoft. Gap fill reversal on Friday, closed week. We're underneath the weekly cliff. And what does that mean? It means there's nothing but thin structure retracement underneath us. This is where we would say, okay, consolidation underneath 365.75. Sayonara, we're looking at 345.15 to retest the breakout point. If we do get back above the weekly cliff, I would still entertain lower highs here underneath 377.25, maintaining this as a bear flag, right? Lower high rejection, looking for further downside over time. Where does it invert? There it is. Show me that. We will start to talk more about structure, but we're not there yet. Let's take a look at the Apple chart. Apple got brutalized into the end of the week. There was no hiding here. I saw something online that was like there's going to be an additional, I think it was like more than $350 input cost increase per phone, which of course will translate to much more for you as a consumer. So expect iPhone prices to go up. Anyhow, as we look at the technical chart in front of us, there was a gap close on the Friday session, or most of the gap closed. And then where did we close the session? At the lows. So if stronger buyers were going to be here, if this was going to be a V-shaped recovery, we should have closed strong at the highs. Not the case. It does look as though we can still see some further downside out of Apple so long as we're underneath. I would really just use 196. If we're under 196, you're underneath all of this as overhead supply coming from the major gap down on this previous earnings cycle, right? Gap below us is at 180.25, closes down to 173.40. Those are your levels. Again, the point of today's exercise is really looking at the levels and just understanding that we're in a bearish regime still. There's nothing that's changed on the long side. We just want to update the levels, really. That's all we can really do at this point. Out of Amazon, what do we have? A little bit of a green day here, but still fading off of the gap close. That was the trade of the day on the Friday session, actually, off of 177, 176.90s, give or take. Anyhow, the current look of the chart with the close underneath this consolidation lows, to me, would just be another idea of a lower high on a smaller time frame, bear flag consolidation, and looking for downside. If this is going to turn into a stronger reversal to the upside, I would need to see acceptance at minimum over Friday's high, if not just closing the gap rapidly overhead and building out a higher low that we can architect new trade ideas off of into the future. We're just not there yet. Let's move along to Google. Another bearish chart here, and at risk of course, breaking down through a monthly, perhaps, double top neckline underneath 147.75. Just nothing here that is nothing compelling on the long side, right? And sure, maybe the market rallies a little bit on the Monday session, but in terms of spotting an entry here that seems reasonable, you're just trying to catch a falling knife. And like, I get trying to buy the lowest low always gives you the best trade, the best leverage in terms of the expected value of the trade there, but your confidence, your percent win rate is going to be in the gutter. So I don't really see buying this as being too valuable as of right now. Maybe gap fill reversal could play, and then like a higher low back over the neckline. So basically you would need a weekly failure pattern, right? Look below and fail on the weekly over 147.75. Maybe we have a small time frame daily double bottom, and then we look to move higher from there. But so long as price acceptance is underneath 147.75, I mean, the downside levels really speak for themselves. Meta, what's going on with the metaverse? Nothing other than the same brutality, right? You have yourself the head and shoulders, you have yourself the neckline, you've got the big move to the downside. You're coming into a congestion zone, so we'll give a little bit of credit there. Is it possible that Meta just starts to go a little bit more sideways in here? Maybe. What would I want to see, though, to get involved? At least acceptance. You can see that I've turned this into a dotted line because there's sort of Thursday just blasts right through it, but 537.25, if we're over that, then maybe there's a counter trend to close the major gap overhead. That was more so from Wednesday into Thursday, daily 200 SMA retest. That's 586. That could be a play, but for now, this is just like consolidation week on the lows. We'll continue to walk things down until proven otherwise. If we do get a counter trend, look below and fail, great, we close the gap overhead. So you have the levels, and again, the exercise is to really just show where these levels are coming from and what we have up and down. As we look at Tesla was the dark horse that if anything was going to sort of withstand the tariff news, it was Tesla. There it is, no reaction on the Thursday session, actually just an inside bar. Friday, unfortunately, could not hold support off of 250.50. I was very open-minded to this, acting as the dark horse trade, but just didn't play. So being underneath this now makes me think if this needs to turn into a weekly double bottom, we've got a little bit more patience to exercise here. We do need to see if buyers step up towards this 233, also down towards the earnings gap close level, which is 218.85. If we see buyers step up here, then again, maybe it turns into a weekly double bottom. We could probably get an early entry daily wise on something that looks like this again, very similar to what we had over here. Remember, the main premise of this idea was along off of this level. If the same thing is going to happen, it's still a level of interest at 250.50. So I'm carrying that forward as we come barreling into earnings, not this week, but towards the end of the month. Let's take a look at JP Morgan. Earnings are this week, Friday, of course, as we've just outlined earlier. And just like the XLF chart, there's your head and shoulders. It's not really looking great. I would think that there's plenty of room for a gap fill reversal here. And the only time I would get bullish out of JP Morgan is something that looks like this. Could it be a Friday earnings gap up to somewhere in here? I mean, maybe, but at this point, it seems as though that's a lower odds trade. And I would not want to swing trade options through earnings anyways, especially given the current context of implied volatility out there. It's rocking and rolling. What else do we have? Downside levels you can spot from this low, and this previous shelf here. 201.75, 199.50, 188.50. Moving along to Netflix, and then two additional ideas for you. Here's your weekly head and shoulders. There's your neckline. We're testing. We are testing. The daily head and shoulders was even better. Here's this through the neckline underneath this cluster of lows. 897 on Friday. Rock and roll right to target at the 858.75. So nicely done out of Netflix, but building out a higher time frame threat now. If we're underneath this daily 200 SMA could be interesting. The next major short to me would be like put in consolidation here and then show me this. This range here, this thin structure retracement would be more attractive to the downside. That's Netflix. Let's finish it off with a couple of ideas. Burlington Coat Factory, Burlington Stores. You want to talk about tariffs. You want to talk about goods that maybe get not going to feel the love in a recession. I'm not seeing it here. So weekly structure, of course, starts to look like a head and shoulders. daily structure starts looking like a bear flag. We have got this big earnings cycle gap to close off to our left. Nasty inverted hammer on the Friday session. It tried to break over Thursday's high, rejected the daily 50 SMA, and closes underneath Thursday's low, even after a small countermeasure rally off of the low of day. I would be very interested in a move underneath 225 out of BURL, Burlington Stores, to look for this. Show me the move. Show me the move to 201. I mean, a 24-point move, definitely worth watching out for here in what seems to be a multitude of different patterns playing out, right? As well as the engulfer failure that we just talked about. That's a short-sighted idea. And then we honestly have a long-traded idea, if you could believe it. CAH, Cardinal Health, strong pullback, smack into an uptrend at a 50 SMA and breakout level around 129.75. Let's take it down to the hourly time frame chart. Let's get rid of those studies real quick. Let's just say we want to load up this one. Good. And if there is going to be a counter trend move off of this, I mean, honestly, I would start thinking about this as a potential target, the opening print of Friday. If we could put in some sort of look below and fail, higher low back in range. And the premise of the look below and fail is basically that we get an inverted head and shoulders. If that happens at 129.75, we're talking about 134.50. 134.50. There we go, round numbers only. We've got I mean, that's huge. That's a large range to be trading for out of this particular name here. So interested in that. Obviously, if it breaks down and the whole market continues to crumble here, not so interested, and we will just focus more so on the short setups that we've evaluated through today's session, which is primarily looking at the lower highs across the Mag 7 companies or just straight up continuation to the downside into these extended levels that we've just discussed and added to the charts via some maintenance this morning. That's going to do it for today's episode of the Weekly Watch List. There's a lot going on out there. It's getting crazy. It feels hectic. Just a reminder, if it feels overbearing, if you feel like you're going to make an emotional decision that is the wrong decision at the wrong time, there's nothing wrong with sitting out from a trading perspective until things settle down a little bit more. Remember, the name of the game is staying in the game. One trade can blow up your account. It's very unlikely that one trade is going to make your career and you're going to be set to jet and ready to retire after one trade, right? The name of the game is longevity. I think it's important to end on that note. The market's getting crazy out there. Don't be so worried about like catching the exact bottom. If the market's going to rally back to all-time highs over time, there will be a structural low that you can get involved in. If the market's going to continue to move in the downward direction, that's okay. There will be lower high shorts to take in the future when the market settles down just a little bit, and you can still trade the short side. That's what I've got for you in today's episode. I hope you thoroughly enjoyed it. We'll do it all over again this upcoming week. Pre-market preps. We're here to guide you and watch markets together, see how things are unfolding. Come join us up in the office, 8 o'clock Eastern time. Every day the market is open. We will see you here at the office, getting the job done, building some pathing, keeping you on the right side of the trade. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. And with that said, have a green trading week, and I will see you in the next one.